You've heard the hype before. You've watched the polished Instagram videos and read the glowing articles that paint the Carolinas as the final untouched slice of the American dream. Affordable houses, comfortable weather, new job opportunities, charming main streets. From the outside, it all seems flawless. But for tens of thousands of recent homebuyers, that picture is starting to fracture. This isn't a mild market correction for many families. It feels more like being caught in a slow, tightening squeeze. Monthly payments that once seemed manageable are now draining every paycheck. Sellers who expected to list a home on Friday and accept an offer by Monday are instead watching their properties sit, get discounted, and then sit again. Behind the upbeat slogans and relocation ads, there are communities across North Carolina and South Carolina where the housing market is quietly flashing warning signs. Before you load up the car and head south, it's critical to understand what life really looks like on the ground. Today on Stable World, we're taking a full road trip through the Carolinas, stopping in 10 different cities where the numbers and real-world conditions are telling the exact same story. Inventory is stacking up, affordability is cracking under pressure. Rising insurance costs and higher taxes are eating deeper into household budgets. In some areas, the issue is too much new construction. In others, the local economy depends almost entirely on a single industry. Stay with us until the very end because our final stop is a popular tourist destination where locals are already whispering that entire condo buildings feel dangerously close to becoming ghost towns. If you care about protecting your financial future, hit like now so this warning reaches more people before they sign the wrong contract. Be sure to subscribe to Stable World so you can spot the red flags before the sales pitch does. And let us know in the comments if you're seeing price cuts or homes sitting longer than expected in your own city. Strap in and keep your eyes forward. We're driving straight into the storm. Number 10. Gastonia, North Carolina. Our journey starts just outside Charlotte as we roll west into Gastonia. At first impression, it comes across as a traditional Carolina mill town in the middle of a makeover. Former brick factories have been repurposed into loft apartments. Craft coffee shops now sit on corners once occupied by hardware stores, and fresh subdivisions stretch outward along the bypass. On a quick drive through town, it feels like progress is everywhere. But once you start scrolling through home listings, the story changes fast. Price reduced appears over and over again. Sellers are dangling incentives, help with closing costs, bundled appliances, even mortgage rate buydowns, all in an effort to keep buyers from backing out. Homes that would have triggered bidding wars during the peak frenzy are now lingering, quietly adding days to their time on the market. The energy has shifted from rush in now to wait and see what happens. Gastonia's core challenge is that it tried to play two roles at once. It aimed to be both an affordable alternative to Charlotte and a full-blown comeback city with its own identity. Prices climbed rapidly on the assumption that commuters and remote workers would endlessly flow in, happy to drive a bit farther in exchange for a cheaper home. The problem is that local wages don't resemble uptown Charlotte banking paychecks. Once interest rates rose, the disconnect between what people earned locally and what homes were selling for became impossible to overlook. In established neighborhoods, longtime residents are staring down higher property tax bills tied to peak valuations, even as nearby homes quietly slash prices just to move. In newer developments, investors who snapped up starter homes as rental properties are finding out that renters now have leverage. Tenants are negotiating harder on rent and demanding move-in perks. Vacancies that once lasted days are now stretching into weeks. Gastonia does have real assets. There's history here, solid rail and highway access, and genuine effort going into revitalizing the downtown area. But none of that changes the fundamental math of a housing market that ran ahead of itself on the promise of nonstop spillover from Charlotte. Buying in Gastonia today isn't just about scoring a charming home with a lower price tag, it's a bet. A bet that wages, taxes, and buyer demand will rise fast enough over the next few years to justify prices that already feel stretched for many who live and work in the city. Number 9. Spartanburg, South Carolina. Leaving Greenville behind, we cross the state line and head into Spartanburg, a longtime regional hub with deep roots. On the drive in, it actually looks like a win. New neighborhoods, freshly poured roads, and development signs popping up along what used to be open farmland. From a distance, it feels like a city on the rise. But once you slow down and look more carefully, a different story starts to emerge. Builders didn't simply add homes here, they overwhelmed the market. Active listings in Spartanburg have jumped noticeably. Tract after tract is packed with spec homes, model units, and nearly completed houses, all competing for the same pool of buyers at the same time. Sales centers are leaning hard on incentives, mortgage rate buydowns, free appliances, closing cost assistance, whatever it takes to keep deals from unraveling. That isn't a sign of strength, it's a sign of pressure. And it's not just new construction feeling the strain. Existing homes are getting dragged into it too. Resale listings are sitting longer than they did a year ago. What used to be a 2-week turnaround has quietly stretched into a month or more for a growing number of homes. Once buyers realize they're no longer forced to jump on the first property they tour, behavior changes. They take their time, negotiate more aggressively, or step back altogether. There's another trend that's harder to ignore. Foreclosure activity in the surrounding county is beginning to rise. That points to households who bought near the peak with slim savings and tight margins, and who are now having trouble keeping up with their loans. As inflation and higher interest rates chew into everyday expenses, the pressure adds up fast. Spartanburg was marketed as the affordable alternative to its flashier neighbors. But that label is starting to cover up a basic reality. At today's prices, there are simply more homes than there are qualified buyers. If you're thinking about buying here, the real question isn't just whether the house looks like a bargain, it's whether you're actually getting value or stepping in to absorb the fallout from someone else's building binge. Number 8. Rock Hill, South Carolina. Just south of Charlotte sits Rock Hill, a city that was heavily promoted as the smarter alternative. Same metro gravity, an easier commute, more square footage for the price, and calmer neighborhoods. For a while, it felt like a loophole. You worked in Charlotte, went home to Rock Hill, and watched your home value rise as more people followed the same path. By 2026, that upward march is no longer a sure thing. Drive through the newer subdivisions and the warning signs are sitting right on the front lawns. Price reductions, offers to cover closing costs, builder incentives stacked on top of each other. Homes are lingering longer than they did a year ago, and many listings now need multiple cuts before a buyer finally steps in. Back on market signs are appearing more often, and open houses feel noticeably quieter. Rock Hill's housing market moves in lockstep with Charlotte's job engine. When the Queen City slows, banking and tech hiring cools off, relocation packages shrink, and remote workers stop stretching their budgets. Add higher mortgage rates to the mix, and many families simply can't qualify for the prices sellers are still hoping to get. Appraisals come in low, deals wobble, and owners are left with a choice: reduce the price or watch the contract fall apart. Investors are adding another layer of pressure. During the boom, out-of-state buyers snapped up starter homes to rent to Charlotte commuters. Now rental demand has softened. Vacancies are rising while insurance premiums and property taxes continue to climb. When multiple investors decide to exit at the same time, they dump homes onto the market, pushing comparable prices down block by block. Rock Hill isn't in freefall, but the era of assuming a quick sale at a higher price is over, at least for now. Buying here today means you're betting on a rebound in Charlotte and hoping inventory doesn't keep stacking up. The question is, how confident do you feel when the for sale signs are starting to multiply again? Number 7. Winston-Salem, North Carolina. As we head west into the Piedmont, we arrive in Winston-Salem, a city that has worked hard to reinvent itself, shifting from its tobacco and textile roots toward research, healthcare, and medicine. The skyline has real character, and many of the historic neighborhoods are filled with solid brick homes shaded by mature trees. On the surface, it looks like the kind of place where housing should feel steady and dependable. That's exactly why the change happening here is so easy to miss. Markets like this don't fall apart with dramatic headlines. They cool off quietly, one stalled listing at a time. Right now, the warning signs are already there. One of the clearest signals has been a sharp decline in mortgage applications across the metro area. Fewer buyers are even starting the process. That slowdown shows up a few months later as weaker sales, growing inventory, and a rising number of price reductions. You can hear the shift in how sellers talk. There's less confidence and more urgency. Phrases like open to offers and bring all buyers are showing up where firmness once ruled. The first segment feeling the pressure is flipped homes. During the boom, investors snapped up older properties, remodeled them with trendy finishes, and expected fast turnarounds. Now, many of those renovated homes are just sitting. Scan the listings and you'll notice a large share of properties that have been on the market for more than a month, sometimes far longer. something that would have been unthinkable during the frenzy. Fresh paint and quartz countertops don't mean much when the monthly payment scares buyers away. Affordability has deteriorated quickly here. Home prices ran well ahead of local wages, and now the middle tier of the market, once the easiest segment to sell, is stuck in limbo. Buyers refuse to pay peak-era prices with today's interest rates, while sellers are struggling to accept that those numbers no longer work. When that middle tier freezes, everything else jams up behind it because move-up buyers can't buy their next home if they can't sell the one they're in. Winston-Salem still has a lot going for it as a city, but its housing market has clearly shifted from a sprint to a grind. If you're considering buying here, understand this isn't the fading tail end of a boom. You're stepping into a market that's still trying to figure out how much prices need to adjust to match local paychecks again, and how long buyers are willing to sit on the sidelines before making an offer. Number 6. Columbia, South Carolina. We head south again on the interstate and roll into Columbia, the state capital and home of the University of South Carolina. On paper, this is supposed to be one of the more stable markets in the region. Government employment, higher education, and a large medical sector are usually a recipe for consistency. It sounds reassuring in a real estate pitch, and it looks solid in a spreadsheet. But stability doesn't shield a market from too much supply, and Columbia is learning that lesson in real time. What's really happening here is a collision between investor fatigue and a saturated rental market. Drive through neighborhood after neighborhood near the city core, and the pattern becomes obvious. For rent signs line the streets, often several on the same block. Large investor-backed property groups own clusters of homes, sometimes entire streets. Over the last few years, they bought aggressively, betting on non-stop rent increases and steady appreciation. Homes were treated less like places to live and more like inventory. The flaw in that plan is simple. Renters have limits, and their incomes aren't rising fast enough to support endless rent hikes. Now, in several zip codes, rents have flattened and in some cases started to slide. When rental income stops growing, the whole investor model begins to crack. Some owners are responding by unloading properties back onto the market, adding another layer of supply on top of regular resale listings and new construction. And when investors sell, they don't trickle homes out one at a time. They list in groups, which can shift the tone of a neighborhood almost overnight. Inventory is climbing, while the pool of buyers who can qualify at today's interest rates is shrinking. Average days on market are moving higher. Deals increasingly depend on seller-paid closing costs, mortgage rate buydowns, and repair credits that would have sounded ridiculous not long ago. Even with those concessions, buyers are more cautious. They negotiate harder, demand more, and walk away quickly when inspections uncover costly issues. Pending sales are also drifting lower, signaling that future transaction volume is already set to be weaker. For people who live here, the takeaway is straightforward. You may start noticing more for sale signs on your street and more marketing mailers in your mailbox, all chasing a smaller group of qualified buyers. Columbia is easing out of a frenzy and into a grind, and that transition is rarely comfortable for anyone who bought late and expected the market to keep doing the heavy lifting for them. Number 5. Greensboro, North Carolina. Back in North Carolina, we make a stop in Greensboro, a long-standing hub for logistics and manufacturing that once benefited from its central location and comparatively affordable housing. Warehouses, interstates, and massive distribution centers create the sense of non-stop activity. Trucks are moving, freight is flowing, and everything looks busy. But a busy economy doesn't automatically translate into a healthy housing market. Housing runs on confidence, and that confidence is noticeably missing right now. Beneath the surface, the market feels stuck. Many homeowners who secured ultra-low mortgage rates years ago have decided to stay put. They have no interest in swapping a 3% payment for something closer to 7%. That choice has created an odd imbalance. Fresh listings are scarce, yet the homes that do hit the market aren't selling quickly either. Buyers are taking their time comparing options and approaching every listing as if it should already come with a built-in discount. Months of supply, a measure of how long it would take to sell everything currently listed at today's pace, has roughly doubled compared to the tightest stretch of the boom. Price growth has stalled out, and once inflation is factored in, home values in real terms are already sliding. That detail often gets overlooked. Flat prices aren't neutral when taxes, insurance, and everyday costs keep climbing. Another warning sign is the growing number of listings that get canceled or quietly expire. A noticeable group of sellers test the market, fail to hit their target price, and then pull the listing. Those attempts don't always show up in simple price charts, but they absolutely affect the mood on the street. Buyers notice when the same house vanishes and then reappears weeks later with new photos and a slightly lower asking price. Higher-end homes are especially exposed. Properties above certain price points are sitting for long stretches with only occasional showings. The pool of buyers for that tier has shrunk as borrowing costs rose and stock market wealth became more unpredictable. When those higher-priced homes stall, sellers begin chasing the market downward with price cuts, and that shift resets expectations for nearby listings as well. Greensboro still functions as a solid place to live and work, but it's risky to assume the housing market will lift you higher simply because it worked out that way for your neighbor 3 years ago. In this phase, the real danger is paying yesterday's price for a home that could be worth less in real terms next year, all while you're still covering today's taxes, insurance premiums, and higher interest costs. Number 4. Raleigh, North Carolina. Next, we head straight into one of the most talked about housing markets in the country, Raleigh and the surrounding triangle. For years, the story sold itself. Expanding tech campuses, massive research parks, trendy mixed-use developments, and a skyline crowded with cranes all fueled the belief that prices here could only move in one direction, up. Eventually, reality stepped in. During the boom, home prices raced far ahead of local wages, even stretching what many tech salaries could realistically support. Builders poured in, investors scooped up second and third properties, out-of-state buyers routinely bid above asking just to secure a spot in the market. The dominant emotion was fear of missing out. Wait too long and you were out forever. That kind of pressure can push prices higher, but it also leaves a market extremely vulnerable once demand cools. And that's exactly what's happening now. Inventory is rising, incentives are everywhere. In certain neighborhoods, meaningful year-over-year price declines are appearing for the first time in a long while. Buyers are no longer rushing. They're pausing, comparing options, and seriously asking what nearly $500,000 actually buys them. More and more are deciding the value doesn't justify the payment, especially with mortgage rates pushing monthly costs higher than expected. Unsold new construction is piling up to levels that are clearly making builders uneasy. Walk into a sales office and you'll hear about closing cost assistance, mortgage rate buydowns, and free upgrades before you even take a seat. That's not the behavior of a market with overwhelming demand. When sellers start paying buyers just to keep deals alive, it's a clear sign the leverage is shifting. Net migration has slowed as well. People are still moving to Raleigh, but the flow is eased from a flood to a steady stream. That pace simply isn't enough to absorb everything that was built and priced at peak optimism. Raleigh is still a strong job center with genuine long-term appeal, but on the housing side, prices ran ahead of the fundamentals. If you're buying here now, approach it like any other expensive cyclical market. Name recognition alone doesn't guarantee that past peak prices snap back quickly. And while you wait, you're the one covering the taxes, insurance, and interest along the way. Number 3. Charlotte, North Carolina. Continuing south, we reach Charlotte, the region's banking powerhouse in one of the fastest-growing metro areas of the past decade. Uptown still shines, cranes still crowd the skyline, and from a distance, the city looks like non-stop progress. But the housing market underneath that shine is telling a far more nuanced story. On the rental side, Charlotte has been hit with a massive wave of new apartment construction. Thousands of units have already opened, with thousands more close behind. That surge in supply is starting to weigh on rents, particularly in the high-end buildings all chasing the same tenant pool. When rents ease, the case for buying a home at stretched prices becomes harder to justify. If renters can negotiate free months, waived fees, or discounted renewals, the pressure to rush into home ownership fades quickly. Demand shifts back toward renting. On the ownership side, the picture isn't much simpler. The number of homes for sale has been climbing for months. Closed sales are down compared to last year. An increasing share of listings are sitting for 90 days or longer. In certain suburbs, it can feel like entire blocks are listed at the same time. That kind of visibility changes buyer behavior. Instead of asking how fast they need to move, buyers start wondering what's wrong with the house, the street, or the price. Institutional landlords are also changing their posture. Large corporations that once bought single-family homes in bulk have slowed their purchases and in some cases are actively selling. When those buyers step away, a quiet but powerful source of demand disappears. And when they unload multiple homes in the same area, they can push comparable prices lower in a way individual homeowners can't counter. None of this suggests Charlotte is about to collapse overnight. What it does signal is that the easy part of the cycle is behind us. Buying here now requires careful attention. Which neighborhoods are overloaded with corporate-owned rentals, where new supply is piling up, and how dependent your chosen area is on a single major employer or industry. Number 2. Charleston, South Carolina. Next, we head to the coast and arrive in Charleston. Cobblestone streets, historic brick homes, moss-draped oak trees, and postcard-perfect water views make it feel like a place where home prices can only go up. On the surface, it seems like a market built to climb forever. The reality, however, tells a more complicated story. Charleston faces a serious affordability and insurance challenge that can't be ignored. The cost of protecting a home here, especially in coastal and flood-prone areas, has soared. Many homeowners now juggle standard homeowners insurance, separate wind coverage, and flood policies. In some neighborhoods, combined annual premiums have doubled or even tripled in just a few years. And the problem isn't just cost, it's unpredictability. Renewal notices can arrive that suddenly change a household's monthly payment dramatically. For buyers, this can be a deal breaker. A mortgage that looks manageable on paper can fall apart once the final insurance figures hit the lender's calculations. Deals that seem solid sometimes fail to close. Pending sales are down, and total transaction volume has slipped even while headline prices stay high. That kind of mismatch usually signals that sellers will eventually have to adjust expectations because a market isn't truly healthy if fewer deals actually go through. Meanwhile, more homeowners in vulnerable areas are trying to exit before the next hurricane season or the next spike in insurance premiums. Coastal zip codes are starting to see inventory rise. Second home buyers squeezed by higher mortgage rates, tighter budgets, and caution are stepping back. And essential local workers from hospitality to service industries are increasingly priced out of the areas they help support, creating longer commutes, staffing challenges, and pressure on the local economy. Charleston remains beautiful, but charm alone doesn't cover premiums. Before you get swept up by the postcard views, make sure to factor in every layer of insurance and ask yourself whether you want your largest investment sitting on the front lines of both climate risk and rising costs. Number 1. Myrtle Beach, South Carolina. Our final stop takes us to Myrtle Beach, the famous Grand Strand. Neon lights, beach shops, mini golf courses, oceanfront towers, and endless rows of condos, all promising a taste of vacation life. For years, many investors saw this as an easy cash flow opportunity. Rent the unit when you weren't using it. Let tourists cover the mortgage. Today, however, it has become one of the most fragile housing markets along the coast. The first warning sign is inventory. In certain buildings, dozens of nearly identical units are listed at the same time. Same floor plans, same square footage, and almost identical views. When price cuts become the only way to stand out, everyone loses. Each reduction resets the market benchmark, dragging the entire building down, even affecting owners who had no intention of selling. Aggressive price drops are now common. Units that sold for one figure just a year or two ago are now listed tens of thousands lower, and many still sit unsold. Buyers who entered late in the boom are discovering that the equity they counted on existed only on a spreadsheet. Condos add a layer of complexity. You're not just competing with one seller, but with a stack of neighbors selling nearly the same product. Short-term rental income is struggling too. Oversaturation and changing travel habits have left more empty nights and lower nightly rates. Combine that with soaring association fees, covering shared insurance, maintenance, and special assessments, and the cash flow story quickly unravels. Insurance costs along this stretch of coast are intense and unpredictable. Wind, flood, and property coverage continue to climb, and many HOA boards have passed those increases directly to owners through higher dues or special charges. Foreclosures are slowly rising. Days on market are longer than the national average. Myrtle Beach may still lure you with the dream of a cheap beach condo, but the carrying cost and risk of further price drops are very real. At this point, it's less a vacation investment and more a cautionary example of what happens when everyone chases profit on the same stretch of sand at once. Across the Carolinas, the pattern is clear. From inland college towns to coastal resorts, from tech hubs to retirement favorites, the story of 2026 is remarkably consistent. Prices ran ahead of local incomes, inventory swelled in key segments and costs, insurance, taxes, and everyday expenses climbed. Now the market is rebalancing, and that process is rarely painless for those who bought late. This doesn't mean you should avoid moving to North or South Carolina. It does mean you shouldn't move blindly. If a listing looks like a bargain, ask why. If everyone claims a neighborhood is bulletproof, check the numbers yourself. Look at how long homes are sitting, how steep the price reductions have been, and what your real monthly payment will be once insurance, taxes, and HOA fees are factored in. Would you buy in these cities if the price truly reflected the risk? Or is it still too high once you do the math? Share what you've seen in your own market in the comments. Are listings sitting longer, or are bidding wars still raging? Hit like if you're tired of sales pitches pretending that downturns don't exist. Subscribe to Stable World so your next move is guided by data and reality, not just glossy brochures and Instagram hype. Be cautious, be informed, and before chasing any dream in any market, make sure the ground beneath it isn't already shifting.